You're watching the latest news from financialmirror.tv. The financial world's most turbulent week of bankruptcies, takeovers and rescues came to an end with central banks striving on Friday to free up jammed markets, pouring more money in even as stocks and the dollar rallied in response to an emergency US plan to mop up toxic debt. Japan, Australia, India and Indonesia pumped over $42 billion into their money markets as cash remained hard to find, despite Thursday's unprecedented move coordinated by the Federal Reserve to make $180 billion available to the banking system. But in Europe, there were signs that the stress was easing. The cost of borrowing dollars overnight fell back toward the Fed's 2% target, compared with Thursday's London interbank offered rate fixing of 3.84375%, and 3-month borrowing costs also slid. The Bank of England offered $40 billion to banks, but only half of it was snapped up, with a preference for sterling funds and demand for the dollar remaining muted. The European Central Bank has also offered up another $40 billion. European shares rallied sharply, the FTSE Euro First 300 index of top shares up 6%, with banks the biggest gainers. The index is still down about 3.5% on the week and 26% so far in 2008. Wall Street shot up overnight following news of a US Treasury plan to create a fund that would mop up bad debt that has been at the heart of the credit crunch, similar to the one that helped resolve the savings and loans crisis of the late 1980s. The plans offered investors a glimmer of hope for resolution of the 13-month-old credit crisis that sank Lehman Brothers, stripped Merrill Lynch and Bear Stearns of their independence, and triggered an $85 billion bailout of insurer AIG. During the Asian day, funding remained tight, with banks lending dollars to each other at between 3 and 6%, still off a peak of 10% hit on Tuesday. The Chinese government bought shares in 3 of the biggest state-owned banks and ditched a tax on purchases of stocks to support its stock market. Both the Bank of Japan and the Fed kept their benchmark rates on hold this week, and the European Central Bank is expected to keep its rates steady too. South Korean authorities said they would meet next week to work out ways of protecting Asia's 4th largest economy from the impact of global market turbulence. European shares soared on Friday, led by recently battered insurers and banks, boosted by a UK ban on short-selling financial stocks and hopes for a comprehensive US government solution to bad banking assets. Shares in Royal Bank of Scotland, Barclays and Lloyds TSB jumped more than 32% after the Financial Services Authority imposed a ban on short selling on 29 stocks in a bid to stabilise stock prices. Reports suggested US regulators were considering a similar step, with SEC Chairman Christopher Cox expected to make a statement on the issue. Short selling allows investors to profit from falling prices and has helped bring Wall Street icons to their knees. Banks were the biggest weighted sectoral gainer in Europe, with Dexia surging 19.8%, Crédit Agricole advancing 19.5%, Fortis jumping 12% and BNP Paribas gaining 11.5%. Anglo-Irish soared 41% and Bank of Ireland jumped 34%. The DJ Stocks Banks Index was up 15%. Across Europe, Britain's FTSE rose 6.9%, Germany's DAX gained 4.3% and France's CAC 40 rose 6.1%. Shares in HSBC rose 13%, but the bank dropped a $30.63 billion offer for 51% of Korea Exchange Bank, blaming turmoil in financial markets and ending what would have been the biggest cross-border deal in South Korea's banking sector. Spain's top bank, Santander, rose 8.4%. It declined to comment on media reports it was eyeing Bank of Ireland or the troubled US bank, Washington Mutual. Insurers also spiked, with Aviva rising 15%, Old Mutual up 24% and Prudential up 15%. Mining stocks gained on a broad recovery in the market and tracking a rise in metals prices. A more than 1% jump in crude oil prices on US and Nigerian supply concerns supported energy stocks, with BP, gas producer BG Group and Tullow Oil adding between 1.2 and 4%. Russian Prime Minister Vladimir Putin said on Friday that Moscow has no plans to close its markets for political reasons, but sharply criticized what he described as other states' attempts to drag Russia back to the Cold War. Speaking to Western businessmen at an economic forum in the Black Sea resort of Sochi, Putin also said the government should aim to boost competition and cut the potential for market abuse by natural monopolies. Buyers returned to Russia's battered stock markets on Friday, sending prices surging as trading resumed after a two-day halt and a $130 billion emergency state support package helping confidence. The MICEX index shot up 18.4% in the first 15 minutes of trading, recovering much of the week's losses before the exchange imposed limits on the gains. Trading halted temporarily after 35 minutes, and the dollar-denominated RTS index stopped trading at the same time, having gained nearly 14%. Traders said the government's pledge to spend $20 billion on share purchases, cut oil sector duties by $5.5 billion, lend money to brokers and inject huge sums of cash into the banking system appeared to be working. Days after the Greek state-owned Olympic Airways came to an end, with the Athens government privatising the troubled airline and renaming it Pantheon, the Italian carrier Alitalia saw all efforts to save it fail as the CAI consortium withdrew its €1 billion rescue bid. Prime Minister Silvio Berlusconi had rejected earlier efforts by Air France KLM to take over the ailing carrier that recorded a 10th successive year of losses, and the militant union never backing down on any deal. Even Pope Benedict said he would pray for the future of Alitalia, which had been the preferred carrier of the Vatican. The Italian Aviation Authority said it would ground Alitalia if a new proposal is not put forward by the end of September. In sport, the £30 million investment by the new owners of Manchester City to acquire Robinho seemed to have paid off somehow. But the Brazilian forward failed to score either of the two winning goals in the UEFA Cup first-round match against Omonia of Cyprus, held in Nicosia on Thursday night. A record 20,000 crowd turned out to see both of the Manchester City goals scored by Joe, the less expensive of the two Brazilian strikers signed by Mark Hughes in the team's high-spending summer. The local side scored with Claudian Duro, acquired by Omonia for a fraction of Robinho's fee. Thank you for watching FinancialMirror.tv. Have a great weekend.